So hi everyone. I've just recorded a sort of hour and a half podcast session with John Zolidis that you may or may not have heard of. It's been an enormous amount of fun. And for various reasons, I've decided, and John has agreed, to have him talk through one of his older presentations that's available on his website. If you like this, then you should certainly tune into the podcast that's coming up. And if I have anything to do with it, within a month or two, John will have his own YouTube channel, but that's a whole other thing. So, John, I am now going to share my screen so that the viewer can see what you're going to talk us through. And so I'm going to go to screen share, and now now we're going to see, there we go. You should see your Starbucks presentation. Ladies and gentlemen, I'll be the slide guy and John is our analyst. And why don't you take half a minute just to say who the hell you are and who Quo Vadis is? They might not know. Blast away, John.
Sure. So I have my own business for about 5 years. I manage money for individuals, and I also provide research to professional investors, focusing mostly on the retail and restaurant sectors. And the Starbucks is a company I've followed for a long time. It's a great company. And it was really interesting time to talk about it back in 2018. And it's interesting now as well.
And so we're going to try and do this in 10 minutes. But so here we got a list of the all the slides. But, I'm just going to move on. And I guess you're going to comment on each slide. And we're going to go through a slide every minute or so, or even less. So anything to say here?
Okay, so at this point, the stock had really gotten killed, 48 bucks. I think Starbucks right now is trading at $70 after coming back pretty significantly. So at the time, the business had slowed. There was more competition in the US. Frappuccino had kind of matured as a product cycle. People got a little bit tired of how unhealthy and sugar-filled they were. There was also some issues with China, and Howard Schultz was leaving. There was also some stuff going on in the stores, and Starbucks was in the news. So all these things had kind of come together and made investors upset, which created an opportunity to buy the stock.
And so I should, anything to say here, or should I move on?
So there is basically, my presentation is going to look at two things. One, we're going to look at what's happening in China from a growth perspective, what that meant. And then the second piece is capital returns. So the first thing is to look at how big China was. So back in 2017, it was pretty small and not that material, but only 6% of EBIT. But our view was that it was going to grow significantly faster. If we move on to the next slide, it's going to become a much larger and more relevant piece of the overall business. Now, why does this matter?
All right, moving on. Do I move on slides?
Yeah, go ahead. And so here, why does this matter? So here's the answer. So if we look at this table, this is a calculations that I did looking at the Starbucks stores compared to a bunch of other concepts that are public. And what you can see there is that that Starbucks is one of the most profitable concepts that exists out there. But if we move on to the next slide, past that just talks about the margins. Go on one more slide further. Okay, here's the key slide. So Starbucks by itself, we look at the whole blended business, is a very profitable company at the store level, but the China stores are dramatically more profitable than the base business. And so what this creates is a structural thesis for owning the stock. So as you grow from being a US-based business to a more China large component, the overall margins, returns, cash flow, and return on invested capital should increase. And when those things happen, normally it justifies a higher multiple for a stock. So you've got a stock that's just been kicked on its behind from a variety of reasons, with a long-term structural trend working in its favor. And then there's a second piece of the presentation, which we can move on to. We'll just keep going.
So by the way, yeah, that's fascinating. I didn't know that. Well, just briefly, I'm not supposed to be asking questions, John, but why are the returns so high in China for Starbucks? Or is that what we're going to get to?
I can answer that question. So the answer is that Western brands in China often sell at a premium. So Starbucks sells their coffee almost the same price as a cup in North America, but their operating costs are much lower. So the fact that you're getting a much higher margin, higher ticket with lower operating costs gets you this higher margin. Starbucks is not the only company to do that. Nike also sells its sneakers in China at approximately the same price it charges in North America, despite the fact that they're actually produced there, so they don't have to get shipped across the ocean.
Fascinating. Okay, which slide am I going to now?
Okay, so slip forward to the second piece of this. Okay, one more. Okay.
This is like, so if you want to get the presentation, find your way to John Zolidis. You can get the whole presentation. Wait, but there's more. I wanted to stay here, but we're going to move on to, do I stop here?
Okay, so the second piece of this presentation, and this is a little bit more technical from a financial component, was the company had changed its leverage target. And what that meant was that for every dollar the company is producing in an incremental free cash flow, it was going to buy back slightly more of that of shares. And so this has a very powerful impact on a company's overall return profile. It does create a slightly higher risk, but when you have a very profitable business like Starbucks, you can adopt a slightly higher leverage ratio without creating too much risk. But in a way, this kind of supercharges the earnings growth by refunneling the existing cash flow back into the business. And if we move on to the next slide, I calculated that the market cap of the business at that time was 67 billion. And the capital return program that they announced was equal to more than 1/3 of the total equity value of the business being returned. And another piece is that we estimated that based on the share price then and the capital return program, they could buy back 1/4 of the company over just a few years, which is an incredibly large piece of the share base to remove for a large company like Starbucks. Very accretive to business, helps the stock price because there's a natural buyer in the market, and justifies a higher multiple because the return on invested capital improves due to this capital allocation. So these are the two. If we move on to the next slide, a little bit more. Okay. This actually, I looked even further, and I think I calculated that they would buy back that over a 10-year period, you would get the entire value of the business returned to you through either dividends or share repurchases from that price, which is another really powerful value-oriented argument for owning a stock.
So I'm going to stop there because there's so much more here, and obviously we're just doing 10 minutes. I'm going to stop with one thing just for fun, John. That so look, you could have, this is like a 1.5 hour presentation in 8 minutes. I'm just reminded of Glenn Tung when he was talking about InBev, and they were kind of looking at taking on leverage and buying back a lot of shares. And he said, his eyes lit up and he said, yeah, and then in 2025, they'll buy back their last share. So anyway, so that was one presentation. So thank you, everyone. I'm going to stop the video.